Welcome to Elementary, Monday evenings at 6. This is where you'll find me. I hope you're having a fabulous Monday, and I hope wherever you are, wherever you're listening from, that you've had a peachy day. Well, it's been kind of rainy out here in Ontario, and that being said, my guest is going to ask me to join any moment now. What sort of weather have you been getting? It's a little crazy out here, but like I say, the rain is better, and so we're gonna get started any moment now. Hi,
Hello.
Archit.
Hi, Jacqueline. How are you?
Good, and you?
I'm doing great. Thank
That's
you.
good.
Really
So,
excited today.
me excited.
I'm really excited to be on your Instagram live again for the second time.
That's right. That's right. And I'm so delighted that you took time
Thank you.
to do this interview with me. I mean, this is a hot topic. Mortgages, people want to know about it. Some people, I just hope that, if they don't know enough, that they want to learn more about it. And, but just so to mention, Instagram has been having a bit of lag issues. So when you hear me ask the question, maybe count to three. I don't know. We'll try that strategy
Sure.
and maybe answer it thereafter. So let's get started. Introduce yourself and your Instagram handle. Sorry.
Sure. Of course. My name is Archit Goyal. I'm a mortgage agent with Pineapple Financials, and my Instagram handle is the Mortgage Bull, which is at the.mortgage.bull. The Mortgage Bull.
Perfect. And you're with Pineapple.
Yeah,
That's
correct. Yeah, we're a brokerage in North York.
perfect.
Yeah.
Looks like my AirPods are
Sure.
dead.
Of course.
Of course they did.
First couple of minutes are always just to get
Yeah.
warmed up and get settled.
Well, at least we have good connection today, so that's great.
That's
So
true. Yeah.
let's maybe start with you walking me through a mortgage application. Okay.
Yeah, of course.
So, typically what documents are needed. I mean,
Hmm.
obviously, it depends from person to person, but just in general.
Of course. Yeah, let me just give you a quick walkthrough on how I help my clients and how to get the process started. So first thing is I would schedule a call with them, just to get the understanding of what they're trying to achieve, what are their goals with the property they want to buy, and then I'll have them a pre-approval application sent to them, which when they fill, I will analyze and see based on their income, their debts, and the down payment, how much we can help them qualify for. And after that, the next step would be collecting all the documents, which would be, let's say, if you're salaried, then I would need your letter of employment, your recent 3 pay stubs, and bank statement showing that you have the down payment saved, and let's say if you are salaried and you're getting a bonus, then on top of these documents, I would also need your 2 years of T4, which can determine the ratio of how much money extra bonus you've been having. There's a funny thing, like even if you have a 1 year bonus, that cannot count. So you need 2 year average for the bonuses to be counted.
Mm-hmm.
And then if you are on hourly based job, then again we would need 2 years of T4. They want to see consistency. Lenders want to see consistency in your income. So again, 3 recent pay stubs, which will show how many hours you are doing, and the letter of employment, which clearly states the guaranteed hours with the hourly wage. So that will help us determine how much income can be used then to qualify. And if you're a business owner, again, most likely they want to see cash flow, and your 6 months bank statements and your T1s. So I know a lot of business owners, they try and save some taxes, of course. So cash flow is more important, just to see how much they're capable of getting a mortgage.
We never do that. Never. We want to pay. as much
Yeah,
time.
of course. That's true.
No. Um, how do you stay current with all these mortgage regulations and the market trends? Like, how do you stay current?
Yeah, I actually put a lot of time and effort into it. I make this a priority that I keep myself, updated with what's happening in the market because my clients want to know the best situation for them, right? So to give them the best advice, I try to put a lot of time and effort into it. So first thing is my brokerage has, our CEO from a brokerage. He has been the ex-chairman of, Ontario's mortgage brokerage uh, society, and he has 15 years of experience. Every Friday we have like a market update in which we discuss what's happening in the real estate market, what's happening in the mortgage industry, so we are updated and armed with the best information and we can help our clients in that way. And apart from that, we have lender meetings, so all the lenders come in every week and they also discuss what products, what solutions they have for different situations of clients, right? Because every client have situation which are totally different from one another. So we need to find a suited solution for them. So investing my time in getting myself updated for all the products available for my clients, and also talking through to my appraisal partners, because appraisals are the people who go out in the go out in the field and see what the prices of the neighborhoods are, what the prices of the houses are. So getting to know what's, getting in touch with them and knowing what's happening in the market, how are they analyzing the prices of the house. That also helps me to, keep myself and my clients informed on what's happening in the market. Yeah.
Perfect. So of course, mortgages are front and center,
Yeah.
hot topic,
Yeah.
So, maybe give us a little bit of insight as to what's going on right now
Yeah.
um, in this environment.
Well, we've already seen, we've obviously, seen some uptick in people getting back into the market. A lot of, buyers were staying on the fence because we have been seeing some very aggressive interest rate hikes since March 2022 and up till January 2023. And there was a hike every Bank of Canada announcement, right? So a lot of people were on the edge that because the uncertainty that how high the rates would go, and they did not want it to come into the market. But in January's Bank of Canada announcement, they indicated that they will not change the rates, and in March they did not. So that was good enough spark for the people to start coming back into the market, and we have started to see some houses. Some pockets in GTA seeing multiple offers as well, so it's getting busy, and hopefully this trend continues because obviously we need buyers to get into homes because a lot of people have been waiting since COVID as well happened. So we're definitely going to see some more activity in the coming months.
Perfect. We like activity.
Of course.
We
That's
do.
good.
But I know credit, moving on to credit
Mhm.
is not the only thing, but it
Yeah.
definitely is a very important
Yeah.
piece of the puzzle.
Yeah.
So can you maybe give me some criteria in determining,
Yeah.
um, before I ask you this question, someone's
Mhm.
asking, are we expecting an increase again anytime?
um
Um,
Yeah, so that's a good question. I think everyone wants to know. Ideally, what we are anticipating is that rates will tend to be stable. It will definitely not decrease at the moment because what happens is when a rate increase happens to curb the inflation, it takes 12 to 18 months cycle to show its effect. So we started seeing interest rate hike in March 2022. So we're still in the pattern where the effects have to be, visible into the economy. So rates won't decrease, and we are anticipating that they will stay stable. And hopefully by the end of this year and early 2024, we might start to see some, decrease happening, but at a very slow rate. Yeah.
yes, those U.S. banks, or not those,
Yeah.
that U.S. bank,
Yeah.
that kind of hit the news couple weeks last week. I
Yes.
don't know. It's like we're at the
It's
end of
been there.
March. I can't even
Yeah.
tell which week it was. But
I know.
anyhow, so that was pretty alarming, and I think it kind of really put a lot of people like the US on hold
Yeah.
and the whole nine yards. But let's get on with the credit piece, right? Like I
Sure.
was mentioning, credit score is one piece of the puzzle.
Hmm.
And so so can you tell me like what is considered to determine like credit worthiness of a person?
Sure. So ideally, you need to be 680 above, right? If you have that credit score, you're good to go with the A lenders or the prime lenders, as we say, which are the top five banks and other mono lenders on the A side. So if you have a bit less than, you're somewhere between 640 to 680, you are, depending on how the strong the file is, you might, still get into the A side. But then if you have lesser number than that, then we have solutions for you as well. We have B lending, alternative lending, which is also known as, and you have the private lending as well to help you, get into a mortgage and then try and navigate our way to get back into, the A side. And another thing for credit is that, it's always a fear that, oh, my credit score is bad. So what will happen with me? So credit is something, it's not makes you, there's a bit big of a fear actually. That's what I wanted to clear, is that it doesn't make you a bad or a good person. It's just that it's a snapshot of, your current financial health. It's just that how you are dealing with the credits. And and the lenders want to see, right? Because obviously they're giving you money, they want to see that you can pay them back. So that's pretty much it. But it can be fixed over time. Having good credit habits, which we can also discuss, will definitely help you get a better score and get into the best mortgage solutions.
Yeah. So, while we're on credit, maybe I'll just keep down this path,
Yeah,
right? I
yeah,
mean, I'm a big proponent of, credit, being able to get, the way I look at it is it gets you somewhere, it gets you something.
yeah,
And, I, 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 I will say
mhm,
that sometimes I think people don't understand
yeah,
credit.
yeah,
And when you don't understand credit, um, you tend to put credit on the
yeah,
back burner because you don't understand it. So it's like this fear of not even like, let me, peel back the layers and figure out how I deal with it. I think a credit course should be taught in schools. I had a school teacher listen.
that's
But
actually
anyway,
smart.
you
Yeah,
know what? I think a
that's good.
credit course should be taught in schools, like how to manage money. Credits should be taught in schools, like as a mandatory topic of people understanding, what it takes,
Yeah,
and not just kids thinking, hey, you can just write a check or
yeah.
tap your card. Like, hey, you need to have money to do that. Not
This is
just,
actually very true, and I would say that will be very smart if this reaches the Ontario School Board. Because I'll tell you my example. Like when I was in school, the biggest credit at that time I would have it was my phone, and I was always a bit lazy. It's not that I didn't want it to pay, but I was going sometimes overdue my pay day, and I would pay it late with the late fee. That and I actually, when I pulled my credit once, when I got into mortgages and learned how it has to be done, I saw that that these all these non-payments or late payments have somehow affected me. It wasn't bad, but I think it's very smart to give kids this knowledge that they need to have good credit, because a lot of things depend on credit, especially buying a home in Canada.
so the teacher says it's part of the new 2020 math curriculum.
Oh,
Yay! Awesome.
that's great.
Hopefully someone's paying attention in that class. Um, yeah, no. And when you're talking about the is actually the worst default, I would say is not paying your Rogers. I'm saying Rogers because Rogers is a pain.
Yeah,
But it's the worst issue because they seem to like really kind of look at you, because if you can just not pay your credit, where all of us are just attached to the phones these days,
yeah,
on that piece, like I think it counts for a lot. But let's talk about credit while we're on
yeah,
credit, right? um you know um like tell us how credit is weighed, because I think that's where people don't
yeah,
understand. They think it's just about, hey, I paid on time
yeah,
and that's it, but there's more to credit than just
yeah,
paying on time. So
yeah.
tell us about
So
that.
of course. So let's consider a pie chart, right? So 35%, which is the biggest chunk, would be based on your payments history. Creditors wants to know that you're making payments on time. So this is something very important, right? Don't miss your at least the minimum payment which you need to put in your credit card. That is something very important because they want to see that you're calculated in a calculate manner. You are paying what you owe. So that is like the biggest chunk. And then comes the amount you owe, which is approximately the 30% of your credit score. And to explain more on that, that is basically you should not be using more than 30% of what your credit limit is. So let's say your credit limit for your credit card is $10,000. So do not exceed $3,000, right? Once you reach that point, pay it off and then start using the credit, because if you go past 3,000, the algorithm triggers and puts spotlight on you, and then you start decrease your score starts decreasing. So this is one good habit, that not to increase and go beyond 30%. And then 15% of it would go to the length of credit. So if you have a credit card, never cancel the credit card. Let's say you've not been using, doesn't matter, don't cancel the credit card. That also affects your credit score in a negative manner. So, and longer the credit you have, longer the credit you have generated, more better the score gets with time. And then the next 10% would go to like a new credit application. So let's say you want to buy a car, you want to buy a mortgage, that whatever credit score your inquiry is done, that's the 10%. And this is something very interesting, because a lot of people fear that if you're doing a pre-approval, will it hit my credit? Because a lot of people feel that the score is going to decrease massively. But we need to understand it's only 10%. And especially if you are looking for mortgages, five pulls on your credit in 30 days time will only hit once. So if you're shopping around for mortgage, right, let's say you want to go to a couple of lenders, couple of mortgages, and you want to see what the best scenario is, and they pull your credit. So it will only hit once if you pull it 5 times in 30 days. So this is also something which a lot of people need to understand, that it's not a massive hit, but yes, it does play a small role. And then the last would be the type of credit. 10% would be the type of credit. And type of credit would mean, let's say you have a car and you know that every month you have to make these payments, or like a secured line of credit, you know that you're going to make these payments, and you are making those payments on time. Then the lenders or the creditors see that yes, you have the right calculations, you can calculate on what you have to pay, and you pay it off on time. So this is also very small, and some of them, it's just all these percentage combined make those 100%, and that's how your credit is looked at, or this is how you can improve as well. So that's, I think, the best insight I can tell you on credit.
Yeah.
And how to
Yes,
keep
yes.
it
And
low.
that's important, right? Because I don't think most people understand, the amount of credit
Yeah.
that affects. People think, oh, I've paid my credit card. I'm paying my payments on time. And, the other thing that irks me is the minimum payments. I understand, like, some people will get into a little bit of trouble.
Yeah.
But, my thought is what you put on the credit card should be what you can pay at
At
the
least, yeah,
right?
yeah.
Because if you see the amount of interest you're paying, you kind of like
19,
be
20%. That's
your stomach
insane.
will be a knot,
Yeah.
right?
Yeah.
And I mean, I know I sound so cheap by saying that, but that's one place you can save money as opposed to spending. It's frivolous spending, I feel like. But the most important part is, people think that, hey, my balance is $10,000, and it doesn't really affect, right? But it does. And it's a big chunk. It's a big chunk that is taken into consideration.
100%.
So, but tell me, what advice would you give a home buyer right now?
Sorry, I didn't get the question. Sorry.
Advice would you give a home buyer right now?
Yeah. So first thing, the best advice what I would give is start early, because you need to plan for your mortgages at least 3 months before. It's not that you just get up today and you go out and go home shopping. You need to have all your financials. You need to have all your down payments in line. And the best thing is to get in touch with with a mortgage agent, any lender you have trust in. Get in touch and get everything started. And The next would be get pre-approved, because in today's time, when you see multiple offers coming in, you need to have a bulletproof offer. You need to know how much you're approved for. You need to go in prepared. So getting the pre-approval done, which we just discussed a little time back as well, that getting all your income documents verified with a mortgage specialist, and getting, just to make sure how much you can qualify for, right? So that, and you don't want a scenario where you go and shop around and look at houses and then come to know that, oh, I'm not even qualified for this house, right? So you need to be well prepared before. And the third and the best advice is, right time is now. There's no time. There's no point in waiting that, oh, maybe after 6 months prices will decrease, or maybe after 6 months interest rates will decrease. Because we just have to understand the ideal problem with situation. I don't want to say problem with our real estate, is that supply and demand. We have more demand, less of supply, right? So if prices increase and interest rate decreases, then also you're in a tough scenario. And if interest rates are high and property prices have corrected a little bit, which we saw in the last 12 months, that's a better scenario. Because if you have a lesser principal amount and a higher mortgage rate, you still pay less mortgage per month. So, it's, if you're serious to buy, I think it's right now is a very good time to jump in, because late of this year or early 2024, we might see a very tough market. Yeah,
Yeah, they talk about time in the market
that's true.
versus, um, but the most important part is what I tell my buyers, sellers, my sellers who will eventually also be
Yeah,
buyers. It's all about what your situation is, right? And how much are you paying for rent? And if your landlord decides tomorrow
yeah,
they're going to put that house on the market, or tomorrow their family is going to move in, and when I say family,
yeah,
you know, their kids are going to take over, and you need to move. What do you do? Where do you go? You may be paying 1,600 for a one bedroom. You're not paying 1,600 anymore. Think
yeah,
about it. You're going to be like in so much trouble.
yeah,
And on the flip side, not everyone is going to be able to qualify and buy,
yeah.
but there is a plan,
Yes.
and and we do that a lot
Yeah,
with some of our first time home buyers that come to me. You help me a lot with
yeah,
that, but we put a plan together and we say, don't be
yeah.
disappointed. It's not today, but let's work to achieve and get you where you need to be. And we put a plan of action as to what needs to get done, right?
100%.
Which is, yeah, which is so important,
Yeah,
really.
that is the thing that comes with the first initial conversation I have with them, right? If they're not ready financially at the moment, I'll be the first person to tell them that, hey, this is not going to happen, in the time you are thinking, but let's not get disappointed, right? It might happen in 6 months, it might happen in 1 year. So we just need to build that strategy of how we can, increase or decrease the portions which are not helping us. Maybe you have to get more income. Maybe you need some second or third applicant whose income can be used. Maybe you need a bigger down payment, and maybe you can get some gift from your parents, even overseas. That is something which we can use. So there's always tools available, and we just need to fit in the client and their situation in the right timeline.
Mhm.
That's pretty much how it goes. Yeah,
And I think it's also trying to, get get buyers to really think baby steps, right? You
yeah,
buy your starter home and then you move up to your next. I mean,
yeah,
that's how they did it back in the day, right?
yeah.
Nobody just jumped in and got this big mansion
That,
on day one,
that's true.
right?
That's true.
So, variable or fixed? Give us the
Ooh.
insights.
Yes, this is one of the most talked conversation I have with clients on daily basis, because everyone wants to, know what is the best situation, and I want to help them to have the least cost of borrowing as well, right? So, given the current market situation, what I am recommending my clients right now is to go with the shorter term. Don't go for like a 5 year or 4 year fix. Try and go for at least, either 1 or 2 year. And I'll come to a conclusion why I say that is, as I mentioned, interest rates started increasing last March. It takes 12 to 18 months to run, full cycle of these high interest rate to curb the inflation. So Bank of Canada, and what I, have seen their policies and all their research I've done, uh, rates will not start decreasing at the moment, right? They will start decreasing hopefully by start of 2024, and by the end of 2024 we will start seeing those pre-COVID 2019 regular economy rates, which are 3.5% or 4%. So we are still year and a half away from them. So you'll be very safe to go with a 2-year fix right now, so that when your renewal comes in after 2 years, you're in the market hunting the best rates possible in the best, hopefully the best economy situation we're going to see in few years. So, and you can also go for maybe a 3-year if you want to be like, because 1 year and 2 years rates are still a little higher, because mathematically that makes the most sense. So lenders have the obviously the highest rates on the shorter terms now. So 3 years are still you can find something around 5 to 5.5%, which is still not a bad deal. So that you're all done with all these high tides of high interest rates, and once you're back in the market after 3 years, you're again hunting for the best rates. And for variable, I think we are not expecting as aggressive increases again, what we saw last year. Hopefully we are very close to the peak of the interest rate hikes, right? So there could be some like 0.25 or some smaller increases might happen in the duration of this year. So if you have the appetite, if you have that cash flow, and you can you are able to accommodate those increases, go for variable, because the best part of going with variable is that it gives you flexibility. If you have let's say a 5-year variable, and after 1 year you can change that into a fixed, so the remaining 4 years would be a fixed. So this is some flexibility you get with being with variable. And also if you are have plans of let's say selling the house, breaking the variable mortgage is very cheap. It's only 3 months of interest payments compared to what the fix would have. Fix can go up to 10, 20, 30,000 depending on the interest rates and the time left and the mortgage value. So it's more about flexibility, and again depends on client situation to client situation. For some, variable might be a best solution, and for some, fixed might be a best solution. So we just need to understand the whole scenario for the client first.
And they can always do the amortization, chart
Yeah.
just to see what they're paying out, right?
Yes.
I mean, some people are not, big on how much interest they're paying, like how much the amount.
Exactly.
Some people are just looking for a monthly payment. Me, like I said, I'm a little cheap, so sometimes I'm always looking for, what's the best
least you can maybe pay for
yeah.
the month.
Yeah.
You can increase the amortization for sure. You have from 25 years, which is kind of the standard. You can go to 30 years as well. And a lot of B lenders have been offering 35 years of amortization as well now. So, to accommodate such high prices of property prices and get the ratios in line. So those solutions are available. But to increase the amortization, you do need 20% down payment to get into those 30 or 35 years. So a lot of first-time home buyers, usually try and have lesser down payment, obviously, because it's so hard to save so much money for high prices. So for them, it's only 25 years. But yes, if you have more than 20%, you can look into those 30-year amortization, have lower monthly payments. Yeah.
Perfect. So secured line of credit. So a line of credit attached to your mortgage or your home. What sort of interest rates do you see on that?
Yes. So secured line of credits, which are also called HELOC, home equity line of credits, those typically have a little bit higher interest rate than what your mortgage would have. So they go usually prime plus 5.5%. So prime rate is 6.7 right now. So you're prime plus. So and with HELOC, what happens is ideally, I like to say, if you're using the money for a bit shorter term, because your interest rates are a little higher, or you have high paying debts, let's say credit cards or car loans, which usually go beyond 7 and 8% these days, and credit cards are 19%. You can consolidate that by taking a HELOC with a prime plus 0.5%, consolidating those higher interest debts into lesser interest debt payments, and then ride that out and pay that out. So they're usually a bit higher, but a good solution again, depending on client to client, how they want to use the money. A lot of people, what they did do, especially during COVID, was they took out money through HELOC and invested the money somewhere else, maybe bonds, maybe GICs, or more private mortgages, and they were getting returns of 8, 9, 10, even 12%, and the HELOC they were just paying 4 or 5%. So it totally depends how you want to play around with the money and how much return of interest you can get. But typically they are prime plus 0.5% high. Yeah.
Yes, sharing a lot of good information with us. But before you go, one last question. And listen,
Sure.
if you have any questions, I didn't say this before, but if you have any questions, drop it in the
Yes,
question icon.
please do. Yeah.
I know we had one question. Thank you for that question. And mortgage payments,
Yeah.
weekly versus, bi-weekly versus monthly. Give us some insight.
So, see, the basic rule of thumb is the quicker you pay your mortgage, the lesser interest you pay. So if you are paying weekly, you're paying lesser, interest through the whole 25 or 30 year of amortization, whatever you have. So, but weeklies are not that as popular because, a lot of Canadians are paid bi-weekly, so they do prefer at least bi-weekly payments. And again, it really depends on how strong your cash flow is, because if you have a stronger cash flow, you can go and opt for bi-weekly payments. Else monthly would be the best solution out, because this is one of the biggest chunk of payments you spend as a family, right? So weeklies monthly payments are a bit more comfortable, but again, quicker you pay, lesser interest you definitely pay through the amortization period.
So, of course, let me have you guess which one I would pick.
Sure, go for it.
I still had a mortgage.
Sorry?
I said, what do you think I would pay?
I think you should go for monthly, just to have, just a bigger cash flow, right? You can manage your finances. I think ideally, see, this is another thing which I want to put out there. Mortgage is one of the uh, best debts you can have, because it's one of the lowest interest rates you have. So it's ideally not always smart enough to just pay off all the mortgage you have. Maybe you can use that money and invest and, have a bigger return on investment. So you just have to be a little bit more sound on how you want to manage your finances. And obviously, me as an agent, mortgage agent, is always available to, give my guidance and have some expertise from your financial advisor as well. They give a lot of good information to the clients as well. So this is something which they can, look into as well.
Yeah. I think there's two parts to it. I think if you have a home, and then if you have other properties, I would separate them if it was me personally.
Yeah.
Right? For me, a home is a home, and I hate to gamble with my home.
Of course.
But other properties, absolutely, you can pull a little bit, amortize a little longer.
Yeah.
For my home, in my case, I did a weekly accelerated, and I paid it off because we had these 2% rates, and I thought, I'll be damned if you think I'm going to pay you 1 penny extra.
No, at that time
that was very aggressive, right? But it works. It works for some people. It doesn't. And prices of homes these days have skyrocketed so much.
Yeah.
And I mean, we've seen a little bit of a change to that, right? Where the market has dipped, right? Considerably. Although we're still lacking inventory, but the spring market hopefully will bring a whole bunch of, I can tell from the activity on my website, people that have been sitting on the sideline, I can tell when they start to look frantically, how many homes they come back and they're, hey, Jacqueline sent me homes, da da da. So that they are looking, and it's starting to percolate a little bit.
It's definitely brewing up. The people they want to see what's available, and the activity of definitely has increased, and hopefully it goes better. Because a lot of people who want to get their first home, especially, they have been waiting for a long time, because it's been a very unusual last 3 years, right? COVID and economy taking just like a roller coaster ride, sometimes going so low, and now it's been so high, and with inflation and everything. So it's been a very tough ride for a majority of the Canadians, I would say. So it's hopefully things go to the better, and we see some more activity. We see some healthy real estate market, so that everyone can get benefits from it.
Yeah. So here's to a healthy spring market. Thank you for your time. I really, really appreciate you coming on.
Thank you so
It
much
means
for
a
having
lot.
me. Thank you.
And for all of you watching, our viewers, the show is nothing without you. So thanks for joining. And for those of you who don't know me, my name is Jacqueline Watson. I am a realtor with Sutton Group Tower, and hopefully one day I'll get an opportunity to work with each of you. So until next time, please check out my podcast. It's called Elementary. It's available on everywhere podcasts run, pretty much. And if you have a topic that you'd like me to unpack and dig a little deeper, feel free to DM me. I'd be happy to help. Until next time, thank you. Bye.
Thank you so much. Take care. Have a good day. Bye.